Today in this video, I'm going to talk about how to allocate money for investment. Welcome back to my channel. Remember to hit the subscribe button and turn on the notification bell if you like to watch more personal finance and money matters video. Let's begin. Hi, my name is Louis, your financial educator. Consider it the opposite of putting all your eggs in one basket. Allocating your money for investments among different asset classes is a key strategy to minimize your risk and potentially increase your gains. What is asset allocation? Asset allocation means spreading your investments across various asset classes. Broadly speaking, that means a mix of stocks, bonds, and cash or money market securities. Within these three classes, there are subclasses. Large cap stocks, share issued by companies with a market capitalization above 10 billion US dollar. Mid cap stocks, shares issued by companies with a market capitalization between 2 billion and 10 billion US dollar. Small cap stocks, companies with a market capitalization of less than 2 billion US dollar. These securities tend to have a higher risk due to their lower liquidity. International securities, any security issued by a foreign company and listed on a foreign exchange. Emerging markets, securities issued by companies in developing nations. These investments offer a high potential return and a high risk due to their potential for country risk and their lower liquidity. Fixed income securities, highly rated corporate or government bonds that pay the holder a set amount of interest periodically or at maturity and return the principal at the end of the period. These securities are less volatile and less risky than stocks. Money market, investments in short-term debt, typically a year or less. Treasury bills, T-bills are the most common money market investment. Real estate investment trusts, REITs, shares in an investor pool of mortgages or properties. Maximizing return and risk. The goal of allocating your asset is to minimize risk while meeting the level of return you expect. To achieve that goal, you need to know the risk-return characteristics of the various asset classes. Equities have the highest potential return but also the highest risk. Treasury bills have the lowest risk because they are backed by the US government, but they also provide the lowest return. This is the risk-return trade-off. High-risk choices are better suited to investors who have higher risk tolerance. That is, they can accept wide swings in market prices. A younger investor with a long-term investment account can expect to recover in time. A couple nearing or in retirement may not want to jeopardize their accumulated wealth. The rule of thumb is that an investor should gradually reduce risk exposure over the years in order to reach retirement with a reasonable amount of money stashed in safe investments. This is why diversification through asset allocation is important. Every investment has its own risks and market fluctuations. Asset allocation insulates your entire portfolio from the ups and downs of a single stock or class of securities. So while part of your portfolio may contain more volatile securities which you have chosen for their potential of higher returns, the other part of your portfolio is devoted to more stable assets. Important note here, equities have the highest potential return but also the highest risk. Treasury bills have the lowest risk but they provide the lowest return. Deciding what's right for you. As each asset class has its own level of return and risk, investors should consider their risk tolerance, investment objectives, time horizon, and available money to invest as the basis for their asset composition. All of this is important as investors look to create their optimal portfolio. Investors with a long time horizon and larger sums to invest may feel comfortable with high risk, high return options. Investors with smaller sums and shorter time spans may prefer low risk, low return allocation. To make the asset allocation process easier for clients, many investment companies create a series of model portfolios, each composed of different proportions of asset classes. Each portfolio satisfies a particular level of investor risk tolerance. In general, these model portfolios range from conservative to very aggressive. A conservative portfolio. Conservative model portfolios generally allocate a large percentage of the total to lower risk securities such as fixed income, and money market securities. The main goal of a conservative portfolio is to protect the principal value of your portfolio. That's why these models are often referred to as capital preservation portfolios. Even if you are very conservative and are tempted to avoid the stock market entirely, some exposure to stocks can help offset inflation. You can allocate some of your money into high-quality equity funds or even a very small portion into growth equity funds. The allocation is usually 85% to 90% in fixed income allocation and 10% to 15% in equity allocation. Moderately conservative portfolio. A moderately conservative portfolio works for the investor who wishes to preserve most of the portfolio's total value but is willing to take on some risk for inflation protection. A common strategy within the risk level is called current income. With this strategy, you choose securities that pay a high level of dividends or coupon payments. Typically, the allocation is 65% to 70% in fixed income allocation and 30% to 35% in equity allocation. Balanced portfolio. A balanced portfolio is divided almost equally between fixed income securities and equities. The balance is between growth and income. Since balanced portfolios have a higher level of risk than conservative portfolios, this strategy is best for investors with a longer time horizon, generally more than 5 years, and a medium level of risk tolerance. Typically, the allocation is 45% to 50% in fixed income allocation and 50% to 55% in equity allocation. A moderately aggressive portfolio. Moderately aggressive portfolios mainly consist of equities, so their value can fluctuate widely from day to day. If you have a moderately aggressive portfolio, your main goal is to achieve long-term growth of capital. The strategy of a moderately aggressive portfolio is often called a capital growth strategy. To provide diversification, investors with moderately aggressive portfolios usually add some fixed income securities. Typically, the allocation is 25% to 30% in fixed income allocation and 70% to 75% in equity allocation. An aggressive portfolio. Aggressive portfolios consist almost entirely of stocks. With an aggressive portfolio, your goal is strong capital growth over a long time horizon. Since these portfolios carry considerable value, the value of the portfolio will vary widely in the short term. Typically, the allocation is 0 to 10% in fixed income allocation and 90% to 100% in equity allocation. Tailor your allocations. These model portfolios and the strategies that go with them can offer only a loose guideline. You can modify the proportions to suit your own individual investment needs. How you fine-tune the models above depends on your future financial needs for capital, on the kind of investor you are. For instance, if you like to research your own favorite sector and devote time to thematic allocation, you will probably further divide the equities portion of your portfolio into subclasses of equity fund investments. By doing so, you can achieve a specialized risk-return potential within one portion of your portfolio. Also, the percentage of the portfolio that you devote to cash and money market instruments will depend on the amount of liquidity and safety you need. If you need investments that can be liquidated quickly, or you would like to maintain the current value of your portfolio, you might consider putting a larger portion of your investment portfolio in a money market or short-term fixed income securities. Those investors who do not have liquidity concerns and have a higher risk tolerance will have a smaller portion of their portfolio within these instruments. Maintaining your portfolio. As you decide how to allocate your portfolio, you might choose one of the several basic allocation strategies. Each offers a different approach based on the investor's time frame, goals, and risk tolerance. Once your portfolio is up and running, it's important to conduct a periodic review that includes a consideration of how your life and your financial needs have changed. Consider whether it's time to change the weighting of your assets. Even if your priorities haven't changed, you may find that your portfolio needs to be rebalanced. That is, if a moderately aggressive portfolio racked up a lot of gains from stocks recently, you might move some of that profit into safer money market investments. What's the bottom line? Asset allocation is a fundamental investing principle that helps investors maximize profits while minimizing the risk. The different asset allocation strategies described above cover a wide range of investment styles, accommodating varying risk tolerance, time frames, and goals. Once you have chosen an asset allocation strategy that's right for you, remember to review your portfolio periodically to ensure that you are maintaining your intended allocation and are still on track to your long-term investment goals. Thanks for watching. Remember to like this video if you have learned something. Also subscribe to my channel if you would like to watch more of this. See you in the next video.